So, welcome everybody to today's LinkedIn Live. Hope everyone's feeling good. Happy Christmas jumper day as well to anyone who's got their Christmas jumpers on. As always, we hope everyone's currently just flooding in, but we will just crack straight on. So, welcome to today's LinkedIn Live, which is called Mastering Sustainable Financial Growth. I am joined by Leanne, our host, the marketing manager at the One Group. Hey, Leanne, how are you today?
Hi, Becca. I'm good, thank you. How are you?
Very good, thank you. Loving the Christmas jumper.
Thank you.
And on my other side is Adrian, our expert guest, the founder of PPX Consulting. Adrian, how are you today?
Yeah, I'm good. Thanks, Becca. Thanks for the invite. I couldn't find a Christmas jumper, but I have got a Christmas t-shirt.
Got the t-shirt. Excellent. It's what we love to see. So obviously today, Adrian has joined us to explain how the control cycle drives sustainable growth in businesses and to share practical insights for achieving profitability. But first of all, before we do dive in, I am just going to pass over to Leanne, who's just going to give you guys a bit of insight into the One Group and how our finance team can help with your recruitment needs.
Thanks so much, Becca. Yes, so for those of you who don't know who the One Group are, we are a specialist recruitment agency. And the word specialist means that we have different divisions that our recruitment consultants specialize in. And one of those is accountancy and finance. So our recruitment consultants within that division will have a wide network of people within the accountancy and finance industry, clients, candidates. So they'll know the candidates that are looking for new jobs, and they'll know the clients that are looking to grow their team with the next top talent. So if you are in the recruitment industry and you're looking for, to grow your team or for a new job, please get in touch with us because we will be able to help you. We are located in Cambridgeshire, Northamptonshire and Hertfordshire, and we also work the surrounding areas too. So it's always worth getting in touch with us. And I'd also like to say thanks, Adrian, for being here today. I'm definitely going to learn something from this LinkedIn Live.
Well, let's hope so, yeah. Cool. Thanks for the invite.
So obviously, as always, this will be an interactive session throughout. So anyone who's watching, please do pop questions into the comments box and Adrian will be able to answer those throughout. But apart from that, Adrian, if you'd like to just introduce yourself and we can begin.
Yeah, okay. So as Becca and Leanne have already said, my name's Adrian. I'm the founder and director of PPX Consulting, which is an accounting and financial consultancy firm in Kettering, Northamptonshire. I'm also a portfolio CFO for the CFO Centre. And both the CFO Centre and PPX focus primarily on SME businesses rather than big corporate organisations. And my own background is similar. I've been a finance director and CFO at various SME businesses over the last, probably the last 15 years or so. I've got 25 years for total experience in business finance and the sort of management accounting, performance evaluation sector. So that's me really. So today we're going to be talking about the control cycle, which is a mechanism that I've devised over the last 20 odd years to help SME businesses to get control of their reporting and therefore their profit. So that it's all based on control, financial control. So yeah, we're going to move on to that. Does anybody have any questions at this point? I know it's a bit early on.
I actually do. Sorry, Adrian.
Okay, no worries.
What do you mean by the control cycle?
So what we're talking about really is financial control, because in any business, the everything has a financial impact. So when we talk about financial control, what we're really talking about is total control, because if you can measure and control the impact of everything you're doing from a financial point of view, then what you're really doing is measuring and controlling it from a general point of view. So when we say financial control, what we really mean is control of the business. So you can drive it where you want it to go. You can make changes. You can make data-led decisions, and that data needs to be accurate. So the ultimate sort of, I suppose, measure of that we talk about is the correct calculation of profit in a given period. And we're going to look at some accounting concepts that dictate that during this presentation. So, but yeah, it's a good question, because obviously I talk about control and there's loads of different types of control. So people are not always sure what I'm talking about until we really get into it. So, so with that in mind, I suppose that's where the control cycle comes in. So what it consists of really is three elements of control, which is performance evaluation, economic viability, and compliance. So these words obviously really just words, until we sort of get into the context behind them. So what they really translate as is, how are we doing? Is it good enough? And can we sustain it? And this is what it's all about. If you know how you're doing and it is good enough and you can sustain it into the future, then your business can go wherever you want it to go. And it's measuring that the control, measuring the performance, measuring the viability, and then ensuring you've got compliance and sustainability. That's what will get your business profitable and grow it, really. So and I suppose in terms of growth, what we're talking about is profitable growth. Growing your turnover doesn't necessarily grow your profit, and you just end up sometimes as a busy fool. You know, I've literally seen businesses where they're half their turnover, but they make more profit because they're just not throwing good money after bad. They're maximising their margins and just really operating more effectively because they've got these controls in place. So as I've said, this is mainly aimed at SMEs. The reason for that really is because 99% of businesses in the UK are SMEs. A big corporate blue chip organisation will already have some degree of financial control in place, because otherwise they probably wouldn't have become a big organisation. So in terms of the specific reasons behind that, large organisations are regulated by law and by affiliation. They have to have a lot more regulation. If you're on the stock market, for example, you're subject to a much higher degree of regulation anyway. So it's not an option to put in controls. You literally have to have them in controls, and you have to have them in place, and you're penalised if you don't. So regulation is the first thing. Scale, I mean, literally the size of a business means it needs controls, because otherwise things get disorganised very quickly if it's a big business. Excuse me. Lack of experience, you know, if you've just started a business and you're a creative person or you're a sales driven person and you don't have that sort of financial background, then you might not have the experience to put in the financial controls, whereas a larger organization, they would have probably an in-house finance director, a big finance team, so they'd have that level of expertise in the business. Budget, obviously, the fact that, you know, big businesses generally have more money, they can afford to put in more robust controls. A lot of businesses of a certain size will have an internal audit department or a compliance department, you know, whereas a smaller business or an SME, you can't really afford to do that. And the final thing is failure rate. You know, a lack of control in businesses means that the SMEs fail at a greater rate than big companies do, purely because the big companies have become big companies. So so they're the real. So this is why, I mean, the principles we're going to talk about are equally applicable to all businesses, but the reason we focus on SMEs is because they don't have these drivers to ensure they have the controls in place. So a lot of the time it's more about we choosing to put in those controls rather than we have to. So that's the reason why it's aimed at SMEs. And the reasons to establish control, again, this is what happens if you don't have financial control. So operational inefficiencies, because you don't have those controls in place. There's money, there's wastage of stock, there's money being lost here and there because you don't have the right data in place. Poor quality data, because you don't have the controls in place to really measure things effectively. So you don't have the data to make decisions, and because you don't have that data, you make knee-jerk decisions. So you make decisions really off the cuff based on guesses or estimations that are sometimes wrong. You might also have the wrong people in place, because you don't have the data to know what the business needs. So you might recruit the wrong person or the wrong skill set. And then knee-jerk decision making often leads to constant changes of direction, because you think the problem was this, so you react to that and you put something in place. It turns out that wasn't the problem at all, so now you have to go back in the other direction. And all of these things really combine to create an unproductive culture, because it often leads to a blame culture, because people don't know why there's a problem, so they just sort of latch onto the most likely candidate and blame someone, and it isn't that person who's resistant to that blame, and it can just create a really unproductive environment for people to work in. And ultimately, the biggest symptom of a lack of financial control is business failure, as we see all the time, unfortunately, especially in the current climate. So now there is a sort of a rule around that, why a new business fails. This is a sort of, it's not a well-recognised rule. It's something I sort of coined in my book. Oh, by the way, I haven't written a book. It was published in August. If you want to have a look on Amazon, it's called Achieving Profitable Growth. So this is a theory of mine, which is, well, it's based on actual statistics, but it's based on what I've seen with my own eyes over the years. So the 2060 rule basically stipulates that 20% of businesses fail in year one, which isn't terrible, because it means 80% obviously survive year one, but 60% businesses fail before they reach the end of year three. So, and these statistics are pretty consistent. Obviously, it's not always exactly 20% and 60%. It fluctuates slightly, but there's no major deviations from that. And going back years, looking at different economies, different countries, this is a fairly standard sort of rule that's just organically come about. But there are reasons for it, and they largely central centre around the lack of financial controls. Because when you start a business, and obviously we're in the UK, so I'm talking about in the UK, but it is actually pretty similar in a lot of countries as well. You don't actually have to produce any kind of financial reporting until 9 months after the end of your first year, which is 21 months after the business has started trading. So up to that point, you're not required to put in any kind of performance valuation, financial measurement, or anything like that. So this is why a lot of businesses don't make it to the end of their third year. So I'm just going to go through a bit of a sort of case study on that and how it tends to sort of map itself out. So if you start your business in year one, let's say it's January, it doesn't have to be January, but for the purpose of this example, it's January to December. So you get to the end of year one, and that is an achievement. And most people at that point know two things. They know how much money they've got in the bank, and they know what the sales turnover was for that first 12 months. But in terms of profit, margins, or any other sort of real useful financial data, a lot of business owners aren't aware of that at this point, because they don't have the financial background to correctly calculate that. But they've made it to the end of year one, and that is something to be to pat yourself on the back for. As much as I'm saying it's statistically easier to do that, it is still a hell of an achievement, really. So then you get into year two, and then, as I say, at the end of the 9th month, you get your accounts from your accountant. You don't have to wait 9 months, but that's what the government allows, and therefore a lot of people will wait until then, because when you run a business, you've got so much else going on that you don't really want to do. A lot of businesses don't want to do things until they have to do them, and this is kind of the theme of the 2060 rule. Is it's about doing things when you have to rather than when you probably should. So as I say, this is 21 months after you started trading is the first time you get visibility of how you've done, and it's not ideal in most cases, because your own records haven't been prepared in accordance with accounting concepts. They quite often differ from what the accountant ends up giving you. So this is where the confusion and panic often sets in for the last couple of months of year two. So year three kicks off, and the standard sort of approach, and bear in mind I'm talking about the 2060 rule. Any businesses that do survive to the end of year three, probably this isn't how it goes, but I'm talking about those that fail. The standard approach really is to just do what we've been doing before, but do more of it. So spend money on marketing, spend money on salespeople, repeat the same things you've been doing, because you're not sure what else to do, because at this point you haven't put in any financial reporting. I mean, obviously the alternative is, at this point, you do put in some financial controls and get some of the stuff that we're going to talk about going. But again, I'm working on the basis that isn't happening, because this is why these businesses fail. So then at the end of the 9th month of year three, you get your accounts for year two. And at this point is when a lot of businesses really just sort of throw in the towel. It also coincides with when a lot of the support mechanisms for small businesses kind of run out. There's a lot of startup support that goes for the first 2 years. And that starts to dry up at this point, because the theory should be that the business is self-sufficient. It doesn't need those sort of startup loans and grants and so on. So, and obviously, it's natural as well that your enthusiasm by this point is starting to wane a little bit. Some of your capital might be running out. So it's not just the fact you don't have financial controls in place, but if you do have the reporting in place that we're going to be talking about, then you would know that these things are running out and that you need to sort of get something more robust in place. So that's the 2060 rule and how it normally manifests itself. And I have seen this in real life several times, unfortunately. And some of them we've managed to turn around. Some of them were unfortunately too far gone by the time we got involved. But this is a fairly well-worn path, unfortunately. So to break the 2060 rule, this is where the control cycle comes in, and it's achieving those 3 elements of control that we looked at previously, but sort of restated in a slightly different way. So the reason it's a cycle is because this process is cyclical. It starts with the performance evaluation, which is the first element of control. Once you've evaluated your performance, you can then assess your economic viability, which is the second point. And then once you've assessed that the business is economically viable, you then look at your sustainability and your compliance elements. So, as I say, the reason it's a cycle is because you have to repeat this throughout the life of your business. If you want to retain control and maximize control, this is what has to be done on a regular basis.
I have a question, Adrian.
Okay, go for it.
How often should companies perform the evaluation?
Well, monthly really is the simple answer to that. If you do it quarterly, you're getting the data too late. If you do it less than monthly, then you're not really getting a big enough data sample to make any decisions. It could actually go the other way and lead you to make more knee-jerk decisions, because quite often during the month things will happen in the first week that right themselves in the third week. And again, it comes down to the execution of accounting principles that if you tried to do those on a weekly basis, you would just it wouldn't be economically viable in itself, because you'd be spending so much money on either wages for your accounts team or external accountants that you would be throwing money away. So monthly is fine. Monthly is the optimum period to do it in. But it's a great question actually, because I do know businesses that do it quarterly. I know some that outsource it, which is fine as long as they're getting the right data from the business. But for me, quarterly just takes, you're looking at data potentially. I mean, it takes longer to do as well because it's quarterly. So it could take 6 weeks to get the reporting in, which means you're now looking at 4.5 months. Data is potentially 4.5 months old by the time you get it. So, you're not really making active decisions then. So yeah, if you do this monthly, and it sounds arduous to do this every month, but you bake the processes into your business and it becomes really something that just happens without you even needing to do much about it. So in theory anyway. So I've talked about accounting concepts. These are the 3 accounting concepts that, in my opinion, all business owners should be familiar with. And also, in my experience, not all of them are. So I'm just going to run through them. Not in any major detail, because actually in later parts of this same, we're doing a 6-part sort of journey on this. So this would be explored in more detail later on, but it does need mentioning now. So the accounting equation, which is assets minus liabilities equals profit, which we're going to see in action actually in the next few slides. Double entry accounting is basically driven by the accounting equation, but it says for every debit there should be a credit. And then the accrual accounting convention stipulates that costs and the revenues associated with those costs should be recognised in the same period. So as I said earlier, the key metric we're looking for is the correct calculation of profit in a period. If you've got the correct calculation of profit, but the timing isn't right, then you're still not going to have the right data to make decisions with. So the first 2 concepts there are all about numerical accuracy, and the third one is about the accuracy of timing. And the beauty of this is, if you stick to these principles, firstly, your management accounts will match your statutory accounts, barring a few sort of minor adjustments that your accountant might make. But the other good thing is that the reporting that's produced is flawlessly, what we call flawlessly reliable, and we'll sort of demonstrate how that pulls together in the next couple of slides. So performance valuation is the first of the 3 elements of control. So as I say, this should be done monthly. And the principle here is that if you don't measure it, you can't manage it. This is what I use as a bit of a tagline. If you don't measure anything really, not just financial stuff, it's anything at all, stock or labor hours or whatever, or anything even outside of business, if you don't measure something, you can't manage it. So there's multiple ways to report on performance, and there's a few examples here. So, sales reporting, labour analysis, KPI reports, scorecards get quite a lot of use at board meetings, for example. Stock counting is important if you're a business that manages stock. Cash flow reporting is obviously vital, and feedback surveys from customers. These are all examples. There's way more than that, and I'm sure people watching in their businesses have got their own, different reporting mechanisms that they use. So this is a small example of what could be, hundreds of different types of reporting, and it's very business specific. But none of these give you the flawless reliability that we're talking about in terms of financial controls. So that's where really management accounts come in, because they do give you that flawless reliability. And I'll explain how. I mean, you don't need to, I know these numbers look quite small, but they're all fictional numbers anyway. We're not breaching any data protection here. So you don't really need to see the numbers. It's more about the principles behind it. So I have quite a few clients that have come to me and said that they've already got management accounts. And when I look at what they're actually using as management accounts, they're not really management accounts. It's just a P&L, or it's a list of P&Ls going month by month. And really there's certain characteristics that you need to have in your management accounts to make them what we would call flawlessly reliable performance valuations. So first thing is a budget. One of the next sort of steps on this, the next presentations in this path is about budgeting. So we're not going to go into massive detail here, but you need a budget, because otherwise you're not looking at how are we doing, you're looking at how we did, which is not really what we're trying to achieve here. It also helps to have another comparative there with your same month for the previous year, just to see how the business is growing. It's less important in a younger business, because you would expect to be growing year on year anyway. But once the business is stable and it's established itself in the marketplace, you would definitely use this as a bit of a metric to see how things are growing. And then you have the variances against each, which we would then use in variance analysis, which is another part later on. But the real principle we want to look at here is for management accounts to be management accounts, you must have as a minimum these 3 reports. You can add in the stuff that we looked at on the previous slide, like your sales reporting, labour analysis, all those sorts of things are business specific or industry specific. These 3 elements here, all businesses should have. And if you don't have these 3 things in your management accounts, then they're not really management accounts, because they're not giving you that flawless reliability that I keep talking about. And the reason for that is those accounting concepts. So, for example, if we just look at the balance sheet in isolation for a second, we talked about the accounting equation earlier, which is assets minus liabilities equals equity. And this is where you see that manifesting itself. So here's your assets at the top, here's your liabilities here, and here's your assets. So this net assets figure here is your assets minus your liabilities. And then here's your equity here. And as you can see, they match exactly. So this is literally assets minus liabilities equals equity, means that those 2 numbers should always agree. And there's no exception to that rule. It's got to be the case, otherwise there's something wrong with your accounting system, basically. So that's always going to be the case. So then how does that link to the other documents in your management account? So your current year profit is there, which is this same number that's reflected here. So it's worth pointing out at this stage that we're talking about January 2021. So this would be the first month of this business's trading year. So when we say current year profit, it's just got the profit from January. I've done that for a reason, because I want to illustrate this point. But if this was February's accounts, then the total profit for the year would be in there. Because your P&L, or profit and loss, or sometimes known as an income statement, is the activity in that period. So this is just what happened from the 1st of January 21 to the 31st of January 21. Your balance sheet, on the other hand, is the balance of all your assets and liabilities since the business started. So where we've got a bank account here, a bank balance here, 42,887, that's the cumulative bank account since the business started. Just as this down here includes the total profit. If we go back a slide for a second, the retained earnings is all the profit made in previous years that's still held in the business, and the current year profit there is what's been made this year. So it's important to note that this the P&L is just for that one period. The balance sheet is up to the end of that period. So, but all the balance is up to that point. But as you can see, the 16,543 profit there, if that was any other number, then this number here wouldn't be 52,387. So, and then it wouldn't balance to the net assets. So the accounting equation would fail. So this here keeps the P&L honest, essentially. So, you know, you could, it just stops any possibility that you're fudging numbers here just to make everything agree, because it must agree to that, otherwise it wouldn't balance. And then just to sort of close the loop on that, we then bring in the cash flow statement. The starting point for your cash flow statement is the profit made in the period. So the 16,543 obviously matches to that. And then the closing balance of 42,887 then matches to your balance sheet. So there's nothing for anywhere to hide. All these 3 statements reconcile to each other. And just to completely close the loop, this 42,887 at the end is your bank balance. So you could literally run a bank statement or go on your online banking, and that's what the balance should be on the 31st of January 21, 42,887. So not only are you reconciling to all of your internal documents, you then have a fail-safe, because you're looking at an external document from your bank to verify that that's the case. So that's what I mean about flawless reliability. If you execute this process every month, you know that everything has been captured, everything that's gone in and out of your bank account has been captured, either on the P&L or the balance sheet, and everything is in sync.
So Adrian, I have a question on that actually. Is this something that people get their accountancy firms to do for them?
Well, that's a really good question, because some businesses do, but they're the businesses that are paying a lot more money to their accountant. And this is a major sort of, again, it's another sort of misconception that I come across all the time, where people are paying for an accountant, but they haven't really checked what their accountant is doing. And I've had people come to me and say, oh, I get a great deal for my accountant, it's only 100 quid a month. And I always think, or I always say to them, well, that's because he's not doing much. You know, I'm not knocking their accountant. You know, it's just, if you don't pay for them to do certain services, then they're not going to execute those services. Most people, in my experience, most business owners look at their accountant in the same way they look at car insurance, which is, we need to have one, so let's just get it as cheap as possible. But then they also assume that their accountant is covering all of their financial controls and everything else in their business, which is very often not the case unless you're paying them a significant amount of money. It's not about the money, it's about the fact that if they're doing a lot of work, they're going to, need paying a bit more money. So, but yeah, it is a major misconception that I've come across, that people think, right, I've got an accountant, that's the finances sorted. It's not, it doesn't work like that. People, you do need to speak to your accountant and check that they are doing what they're doing. And most accounting firms will certainly do this. We do this for lots of our clients, but equally, I've had clients come to me and say they've had a quote for 150 quid a month. And then when I say, well, ours is going to be a bit more than that because you're asking us to do all this stuff, they then realise that the quote that they had previously didn't cover all this sort of reporting and analysis. So yeah, it's a great question because it's a misconception that I come across all the time, where people think their accountants are doing this sort of thing, and then turns out they're not. They're just doing their year end and their tax, and this obviously is a very different animal. So yeah, good question. Thanks. So just to sort of cover off the cash flow, because I do appreciate that this here is not the standard cash flow statement that most people will be used to seeing, because it doesn't just have the transactions going in and out. So just to sort of cover that off quickly, there are two methods for preparing a cash flow statement. The one on the previous slide is really just to make sure everything has been captured in balances to your accounts. A more traditional, that's known as the indirect method, because you start with profit, you make some adjustments to the accounts, and then you end up with cash movement in the period, which then is added to your opening balance at the beginning of the period, and that gives you your closing balance. So the more traditional sort of bank statement-esque cash flow statement would look like this, where you've got cash in from sales receipts, a little bit of interest received, then you've got all these payments that have gone out, and then that gives you your cash outflow or inflow for the month, depending which way it's gone. And then that's added to your opening balance, and then that gives you your balance down here. So this is more like a bank statement, or what you would see on a bank statement. But the key point is that the closing balance on both of these should agree exactly, and both of them should also agree to your bank statement for the period. So that is the fail-safe. And a lot of businesses I work with, we produce both of these purely because the indirect one can be automated from your accounting system, but we also produce the direct version just to make sure everything has been captured and there's no anomalies. And then this is then reconciled to your bank statement to just close the loop completely. So that's really performance evaluation and the flawless reliability that it provides. It's vital to do that every month if you want to sort of really analyze and ascertain how your business is doing. So just to move on from that, just a little reminder, the three elements of control before we move on to economic viability is: how are we doing, is it good enough, and can we sustain it? So how are we doing is a really good question, but it's got to be taken in context, because it's not how have we done. So your statutory accounts that your accountant gives you at the end of the year, that will tell you how you've done or how you did. But then it's too late to do anything about that. It's a done deal. The scores are in, and that's how it went. To establish how are we doing, this is why it needs to be done monthly, because you're still in the financial year, you still have time to make decisions, but you need the data to make those decisions. But then how are we doing is the first step. The next step then is it good enough, which is the economic viability of the business. So once you've done your performance evaluation, you've got your data from the management accounts, that's the starting point for determining whether it's good enough. And we will go into this in a lot more detail in the later session when we talk about budgeting, because your budget is really your benchmark of whether it's good enough or not. If your budget shows, we're going to make a massive profit this year, but then you're not sticking to what you budgeted, then you're not going to achieve that result. So this is where during the year you need to constantly establish your or assess your economic viability in relation to that budget. Because if you're 50% down on budget, that's probably not good enough. But maybe it is. It depends how your profit margins are working. But essentially, to establish in the broadest sense whether it's good enough, you look at your break-even analysis. So really to establish a break-even point, which is we need to hit at least this much in terms of sales revenue, or we're not going to break even, we're going to make a loss. So to establish a break-even point, once you've got and again, this is something you can use in your budget, you can look at it for the previous year, but most importantly, you look at the actual results for the period you're looking at. But the calculation is the same regardless of which figures you're looking at. If you take your overhead costs, as long as you make enough gross profit, which is, if I just take those red lines off for a second. So the gross profit made by this business in January 21 was 161,668. and the overhead costs, which is the fixed cost of the business usually, was 145,000. So if this 668 was 145, 125, then you would break even. You would make zero profit because you've made just enough gross profit to cover your fixed costs. So once we know that, you can work it backwards and calculate your break-even point. So if you take the total overhead costs and divide it by the gross profit margin, that will give you a sales figure that will result in you breaking even. So it's an important metric to sort of get into your head. Sorry,
Adrian, is the break-even point the same every month?
Highly unlikely. So again, it's another thing that when I say to my clients, well, they'll say to me, actually, our break-even point is X amount per month. And it's highly unlikely, unless any business that has any kind of seasonality, unless your sales and fixed costs and everything else are literally going to be exactly the same every month, then your break-even point won't be the same every month. And this is another real benefit to creating a budget for the year, is that you will know what your break-even point is for each month, but it won't be the same every month. I've come across very few businesses where they've literally, unless they've got if it's a contract business and they've literally got a subscription model where every month they get the exact same amount of money in and all the costs going out are exactly the same as well, then it probably will end up that their break-even point is the same every month. But even in those businesses, they will have fluctuating marketing costs. They'll have other things crop up like motor vehicle expenses, stuff like that. So it's highly unlikely in probably 99% of businesses that the break-even point will be the same every month. So it's a good point, because again, people will look at that as a metric, and if they exceed it or fall short of it, they'll think they've done well or done badly. But in reality, it's not correct data. And this is what we're talking about. It's getting that data as accurate as possible. So that so the break-even analysis will tell you whether it's good enough in the period. It doesn't address sustainability, as in will it be good enough into the future. But it can be used to simulate different activity levels and plan for events that may be coming up, that you suspect are coming up anyway. So, for example, I've known businesses where they've got a contract with a big customer that is going to expire during the year. And at this point, when they're doing their budget, they don't know if that customer is going to renew or not. So what they'll do is produce two budgets, one of them including the turnover from that customer, and one of them where it drops off after through the year. And you can then use break-even analysis to assess the impact of losing that customer, because you can again take the revenue out from that customer, take out any associated costs, and then use the same mechanism we just talked about to divide your overhead costs by your profit margin and establish whether losing that customer isn't going to be that big a deal, or actually it's going to destroy the business. We need to get another customer lined up as quickly as possible. So it's a really useful metric, and it's something that is fairly simply calculated. So, but as I say, it doesn't tell you. It tells you whether it's good enough now. It doesn't tell you whether it's going to be sustainable into the future. So that's kind of the third point of control, is the compliance element, and it is really one of the biggest challenges that any businesses face. And we advocate what we call the braking distance principle. Because this is a really unknown quantity, the sort of sustainability into the future, but it can be less unknown if you apply certain approaches to it. So the first thing we say is the braking distance principle. So new drivers are taught the braking distance. If in most cases, if you drive into the back of somebody, the police and insurance companies and so on will assume that you're at fault because you didn't leave enough distance. And even if the roads are wet, even if the guy in front of you slammed his brakes on, it's still your fault because you should have left more braking distance. And the principle is the same. If you are scanning the horizon, you're looking far enough ahead, you're reading industry press, you're sort of signed up to some, forums for your industry, so you can see whatever might be coming and how it's going to impact you, then it increases that braking distance and gives you more time to sort of, assess risks, manage risks, put strategies in place. And we have to find the best strategic position, as it says here, is to establish how are we insufficient and what can we do about it. And really, these are the things, the sort of most common elements to consider. The market factors, so the size of the market, competition in the market, the other products in the market, how secure is your supply chain? If you're buying from, for example, I've got a company that buys a lot from China, and one year they'd forgotten about Chinese New Year, where the whole country pretty much shuts down for 6 weeks, and they didn't order enough stuff in before that. They ended up in real problems with their supply chain. So yeah, something to consider there. Changes in technology, legislation, regulation, that can all impact a business. You know, certain products can be made obsolete overnight if there's like look at AI. You know, there's certain industries that are really struggling now that AI has come to the fore. Budgetary constraints, you know, you need a certain amount of money to run the business. If you don't have that money coming in, what are you going to do about it? You know, you may need to look at borrowing or, you know, some kind of enhanced credit control techniques. Resiliency, so, you know, really just looking at what you would do if this stuff happened. Unforeseen events, which are less unforeseen if you apply the breaking distance principle. But the truth is, it could be anything. And this is why the third element of control is probably the most difficult to manage, because there could be anything coming down the pipe that is going to impact you. And sometimes it comes so quickly that you don't see it coming. Sometimes you just missed an update somewhere. But I mean, things like even COVID, you know, there were some businesses that did have a pandemic response plan. I mean, obviously they're massive businesses that have big budgets, but, you know, there's a lot of people say nobody saw it coming. Some people did see it coming, and they're the businesses that managed to sort of weather it with a bit more certainty than others. So the more stuff you put into this element, the more you get out of it, really. However, because it is such a sort of wide-reaching issue, we tend to break it down into the three broad groups. So regulation, which is obviously everybody's regulated by HMRC and the legal system. Ongoing, there's a lot of others apart from that, of course, but so the second point is ongoing sensitivity. So things in your business or in your industry that you're always going to have to deal with, you just need to be aware of them and sort of predict the impact. And then external events, which are usually a one-off event, things like COVID or Brexit or you know, the war in Ukraine, things that are hopefully going to pass and not leave a lasting impact. So in terms of regulation, as I say, you've got HMRC and the legal system, tax authorities and law, everybody, all businesses are regulated by them. Most businesses will also be have some responsibilities under data protection, health and safety, corporate and social responsibility commitments. So if you say you're going to plant 2,000 trees this year, you then need to do it, because otherwise, even though it's a voluntary commitment, it will look bad if you don't do it. Industry regulations and affiliations, financial audits if your business is of a certain size. So these are just examples of the regulation element. There's you know, industry specific stuff that could affect all kinds of businesses. And it's worth looking at what, as it says there, what external obligations does your business have? How are you managing those? And do you have your paperwork up to date and so on? So in terms of ongoing sensitivities, like I said, this could be anything in your business that you have to contend with, which is outside of your control, but it's always going to be there. So examples would include, you know, the US dollar exchange rate. If you're trading with China or the US or any other country, this is quite a universally accepted currency nowadays. So you may be subject to the US dollar exchange rate. Weather and shipping conditions, if you're getting stuff imported, then, you know, that is going to be a factor. Commodity prices, so for example, if you're in oil and gas engineering, then the oil price will be a factor. Supply chain, like I said earlier, you know, you need to make sure that's robust and there's not going to be any disruptions. Interest rates, everybody has to contend with that. And then fuel prices potentially. So again, these are just examples. There will be many more than that in different businesses. Best way to manage this is to use alert levels and risk registers. So if you know that the US dollar exchange rate, let's say when it gets to 127, we're going to have a problem. But at the moment it's at 123, so it's fine. And again, this is stuff you would review every month in your management accounts pack, you know, so this would be one of those additional reports you add into the pack, review it every month at a board meeting or something. So having those alert levels where, right, when it hits this level, we need to do something. But at the moment it's fine. You just need to review that every month. And then a risk register. So the most sort of salient risks that your business has got, keep them in a separate schedule, which again would be reviewed monthly and assessed in terms of priority and severity and so on. And then the final sort of element of compliance that we sort of broadly categorize is external events. And to assess the impact is the first thing really, so, or the level of concern. So we use this process, which is a tier 3 event is of least concern. So it hasn't happened at all yet. It might not happen at all. We just need to assess the impact if it does happen. A tier 2 event is moderate concern. So it definitely, it has happened or it will definitely happen, but we don't know yet if it's going to impact the business. And a tier 1 event is the most concern. So that means it's definitely happened or it is definitely going to happen and it will definitely affect us. So once you've graded an external event on that basis. And this could be anything, it could be an Ebola outbreak in West Africa, or it could be a regime change in a country that your customers that you're selling into, or something like that. So again, the type of event is quite broad, and it's something that is difficult to assess on a call like this, because it would be very business specific. But we do work with clients to understand where, what events may impact them and what the sensitivities would be. But it's difficult to do it on a call like this, where there could be different industries and different businesses on the call. And then, so once you've established that something is going to impact the business, it's what do we need to do about it? So this is when we would use a risk matrix, which, a risk matrix is a fairly well-used tool in a lot of sectors and areas. It's used for health and safety. I think it's used in some legal settings and stuff like that. So, but what we would use this for in this situation is right, this event is going to happen. How is it going to impact us? So it comes down to two sort of metrics: severity and probability. If it's highly unlikely to happen and there's going to be no impact, if it does happen, then who cares? We don't need to worry about that. So that would be classed as an acceptable risk. Conversely, if it's definitely going to happen, or it's very likely to happen, and the severity is going to be extensive, then it's not an acceptable risk. So we do need to have some kind of a plan or a strategy in place for when it is almost certainly going to happen. Anything in the yellow sections really is as low as reasonably practicable. So this is where, if it's practical to put in a solution for that, then let's do it. If not, maybe we'll just take our chances and hope it doesn't happen. And that would be really where you would weigh up the costs of evasive action against the impact of that event happening. So yeah, it really comes down to a mathematical exercise at the end of the day, but it is obviously based on estimates and risks.
Adrian,
So yeah, sorry.
Is this risk management, is that done by the finance team?
Well, that's another good question, actually, because it will kind of depend on the size and complexity of the business. So obviously in a big organization, I would expect this to be spread around several departments, but probably headed up by finance, because it would be part of the monthly reporting that would come from the finance team. But they would maybe need to engage with other departments to assess these risks and to understand the costs associated with them. In a smaller sort of SME setting, I would say it would still be, if there was a finance director, for example, then I would expect it to fall into their remit. If not, then it may come down to the managing director. And obviously, if it was a very small business, it would almost certainly be the business owner that would have to do this stuff. And of course, this is where it gets tricky, because a big business, they could put in a whole department to manage this stuff. I mean, I've worked with some really big businesses that literally have a team set up for virtually every type of event that could possibly happen. Like I said earlier, I know some businesses that had a pandemic response plan, but there's a lot of businesses that didn't, because it's just not viable to have that kind of expense. So yeah, it really comes down to the size of the business and the infrastructure within that business as to who would manage this stuff. But it just needs somebody to do it. And again, it comes down to the braking distance principle that I mentioned earlier. If you don't do it, then it shortens that braking distance and something might catch you out. If you do it, then it lengthens it, and you've got a better chance of withstanding whatever comes your way. But yeah, it's a good question in terms of who does what. It does vary. And actually, we do this for some of our clients because they are small, they don't have the resources, so we sort of take it on. And it does take a fair bit of my time, actually, just looking at industries that I have to get familiar with just to assess what a risk might impact one of our clients. So yeah, it's interesting. So just to recap then, the three elements of control is a performance valuation, economic viability, and compliance, which translate as how are we doing, is it good enough, can we sustain it? And if you can get these three elements in check, then that is your business secured, because every business that fails has failed on one of these, well, one or more of these elements. In a lot of cases, it's all three, because they're not even aware of them. And that's the issue, I suppose, is that the awareness of these theories is not as widespread as I would like it to be, which is a major part of our sort of business offering, and why we're doing this session today, is to try and promote these elements. So those three elements is the control cycle. So you execute this every month, it will keep you secure, it give you the best chance of the business surviving and expanding into profitable growth. So that's pretty much it from me. So unless anybody's got any questions.
So I actually do have another question.
Okay.
I think you touched on it earlier. This is the first part of a 6-stage journey. What are the other 5 stages?
Oh yeah, cool. So So yeah, good question again. So this is the control cycle today, obviously. The next step of this will be budgeting, because a budget is the most important document you can produce in your business, sorry. Because it gives you that roadmap to success. You know, it's basically, this is where we're going. If we hit that, if we're going to hit that, then it's good enough. If we're not going to hit that, it's not good enough. So budgeting is quite a complex subject, but it is vital for all businesses. Marginal contribution. So this is where we would look at things like the products you're selling, the profit margins that you're making on them, which customers are giving you the most profit, which products are giving you the most profit, price elasticity, you know, how to get more bang for your buck, really. Because as I said earlier, some businesses half their turnover but increase their profit because they're getting better margins from less products or less customers. And obviously that's the best way to be, because then you can really enhance that and grow it up again and make that growth profitable, rather than, you know, that phrase, what is it? Sales is, no, turnover is vanity, profit is sanity. I don't really like that phrase, but the principle it makes is definitely right. Then the fourth step would be variance analysis. So after you've completed your management accounts, the variances that we looked at against budget in previous year, analysing those variances gives you the information you need to make decisions. So the reason why, because the management accounts will tell you what you did or didn't do, but the variance analysis tells you why you didn't do it. And it works in conjunction with the budgeting element. But it's really the culmination of the whole thing is getting the variances analysed. And then the fifth section is the 4 points of control, which is, again, it's a concept that I sort of devised, which is really there's 4 elements of your business that if you focus on them, the rest of this all falls into place. So that's the fifth step. And then the final step would be maintaining control. So once you've done all this really good work, once you've done all that stuff, how do you then keep it going into the future? Because obviously we've said today, you just need to keep executing the control cycle, but that's simplifying it for this session. It is a little bit more involved than that. So we'll look at the techniques and processes that you bring in to make sure that happens. So that's the 6 steps really from this subject.
Well, brilliant. That's been such a good session. So thank you, Adrian. It's been really insightful. And I hope everyone, obviously, who's attended today has, you know, taken away some good next steps for them in their business. I don't believe we've had any more questions come through. However, if anyone does have any questions, pop them in the comment box and we can pass them over to Adrian, who will be more than happy to answer them. But yeah, thank you again, everyone, for attending. And we hope to see you again soon on the next one. Thanks, Adrian. Thanks, Leanne.
Okay, thanks everyone. Take care. Cheers. Bye.